Hello and welcome to Portfolio Matters, week 114, and normal service resumes with Richard back. But before we get into it, Richard will read the disclaimer.
Thank you very much, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, we had this week the inflation numbers, and in the UK, frankly, they were absolutely terrible. So UK inflation came in hot again. It fell from 10.4% in February to just 10.1% in March. And that was a much smaller drop than anticipated. But the bad news was that core inflation failed to fall at all and remained at 6.2%. Food inflation was the main culprit, rising again to 19.2% year on year. So we are seeing a real cost of living crisis in the UK, with the poorest families spend most on food being squeezed. EU inflation met expectations, falling to 6.9% in March from 8.5% in February. But core inflation actually rose month on month to hit a new high of 5.7%. So everywhere we are seeing core inflation as persistent. Elsewhere, Chinese GDP came in stronger than expected at 4.5% year on year in Q1. So Chinese economy seems to be doing all right at the moment. And our cover photo this week was the Finnish Olkiluoto 3 nuclear power station, which is famously 14 years late, but they've now started commissioning it, which is great news. And in Germany, they have closed down their last 3 remaining nuclear power stations, and they are short-term replacing that power with coal, and they're doing that in the name of cutting greenhouse emissions. So this is UK interest rate expectations, and they are rising again. Bear in mind that the UK base rate is now 4.25%. So the market is now pricing in more than one further rate rise. And that is a big change over the last couple of weeks. Obviously, inflation came in hot, and the Bank of England is expected to keep on raising rates. In the US, we have a similar story. So when we had the failure of Silicon Valley Bank, then we had a big drop in interest rate expectations, and now they're going back up. So the expected Fed funds rate for the end of December is now back up to 4.5%. And the green line is where we are now. The red line is before March payrolls. So the March payrolls showed that US jobs market was not cooling as quickly as anticipated, and interest rate expectations have risen again. Now, this is Germany, and it is the change in electricity production by source over the last decade. You'll see that they have cut down on nuclear, cut down on coal. They have increased renewables, and they've increased gas. And something we're going to cover this week is the US debt ceiling negotiations, and the US and CDS on US government bonds continue to rise. So the market is worrying about potential default in the US, which would have absolutely catastrophic consequences and hence is very unlikely. But the market's worried. And related to that, the US federal deficit has been growing much faster this year than last year. And actually, the TGA is now being really run down. And as we go through this, you'll see that the X date, the date at which the US actually runs out of money, could be as early as mid-June, so 6 weeks away. And finally, a piece of information for all our UK viewers. So one of our Discord members pointed out, as he'd been digging through the government website, that actually the tax allowances for the next few years have been fixed up until 2028. So as inflation, and inflation is currently 10%, keeps rising, so the fiscal drag on all our taxes is going to rise. So we're all going to face much higher tax rates in the coming years. Something to be aware of. Okay, and on to this week's economic data. And there's a lot of it. So the UK unemployment rate actually ticked up to 3.8% in February. And that is because people are coming back into the workforce. We had the March unemployment numbers in the UK, and they were expected to show a net reduction in unemployment claims. They actually showed a rise of 28,200. And although that's bad news for the economy, that is good news for inflation. It means some slack is coming into the workforce. However, the bad news was that February earnings numbers again showed that wage growth was way too high. It was expected to fall to 5.1%. It massively missed, and it came in at 5.9%, which was the same as January. So the Bank of England will be concerned about that. There is no fall in wage inflation. We also had HMRC payrolls for the month of March, and they missed expectations, showing only 31,000 jobs were created, down on February and much lower than expectations. The big news of the week was CPI data, and that was terrible. So March number was 10.1%, massively missing expectations, but down on February. Month on month, it came in at 0.8%. So that's annualized 9.6%. Again, massively above expectations and incompatible with a 2% inflation target. Core CPI missed expectations and was flat. Month on month, that again was 0.9%. An absolutely terrible number, although it was down slightly on February. RPI came at 13.5%. Numbers out this morning, retail sales in the UK for March fell by 0.9%. That was lower than expectations and well down on February. Year on year, they fell by 3.1%. Moving to the EU, we had CPI numbers. They came in at expectations of 6.9%, well down on February, and that's good news. Month on month, though, that was a 0.9% rise. Not good. Core rose from 5.6% in February to 5.7% in March. Everywhere, core inflation is persistent. We also then had the ZEW Economic Sentiment Index for April in Europe, and that was terrible. So it's expected to rise to 13, actually fell to 6.4. In China, we had industrial production numbers, and they missed expectations. So coming in at 3.9% year on year in March, up on February, but below expectations. The big news really was retail sales, which massively jumped in March, beating expectations by a big margin. And it seems that actually the China may be achieving its aim of rebalancing the economy towards consumption away from investment, because investment missed expectations. Okay, moving on to the US, we had retail sales for March, and they missed expectations, falling by 1%. So there seems to be increasing signs of a slowdown in the US. We then had the Michigan monthly survey of consumers, and it showed that in April, their general sentiment increased to 63.5, which is still poor, but better. The surprising number was 1 year inflation expectations, which leapt to 4.6% in April from 3.6% in March. And I strongly suspect that is because of the rise in oil prices after OPEC plus cut, and consumers are very sensitive to changes in oil prices. Current conditions ticked up a bit, better than expectations and better than March. 5-year inflation expectations were stable. We also had some housing starts numbers, and they fell from February, but slightly beat expectations. Housing starts were down 0.8% month on month. So finally, some quarterly data from China, and Q1 GDP came in at a respectable 4.5%, better than expectations.
Thank you for that rundown, Keith. Here's the UK unemployment rate. Is it noise or is it moving up?
I think that's moving up.
And the UK claimant count rate, which over this 12-month chart has shown a significant sort of change in the last month. UK weekly average earnings, which is on an uptrend, as Keith said, suggests that inflation might be starting to get ingrained. Average weekly earnings growth rates in Great Britain, seasonally adjusted, and these growth rates in real terms are negative. So clearly people are suffering a hit to their discretionary expenditure. Also, they may be looking for more pay rises.
Yes.
To cover that off. So we have a downturn, definitive, I would say, a downturn in UK job vacancies.
Although still a lot of them. That's, well over 1 million job vacancies.
Whilst UK employment has risen and economic activity has fallen, there are 400,000 fewer workers than pre-pandemic, which is one of the reasons why the employment market is so tight, I guess.
Yep.
So people haven't gone back to work. So some people have basically walked away from the working population. And so we've got older people leaving the workforce, which is what this chart's showing, and younger people are joining the workforce.
Yes. So the light blue bars are young people, and they are coming back into the labor force. This is quite a difficult chart to interpret because it's the change since the start of the pandemic. You see, actually, so the number of people who left the workforce, young people, has normalized. For old people, it seems persistent. They're not coming back.
UK economic inactivity by reason. So we have students, temporary sick, long-term sick, discharged workers, and retired. And this is showing that the long-term sick is forming an enormous segment of the reason for economic inactivity.
Yeah.
This suggests, doesn't it, two things. One, well, it suggests that the health service is not performing its economic function.
Absolutely. But I was surprised by this because anecdotally, I thought a lot of people had retired early. And actually, that's not the case. Over the last 3 months, we've had a net reduction in retired people.
Yeah. The
big cause is long-term sickness.
Yeah, that is very poor. I mean, the health service is without getting political here, the health service is not performing the function it should be performing with this enormous waiting list, 6.7 million people.
Yeah.
And it needs to be properly addressed. So the recent rise in employment has been driven by part-time work. And we all know that part-time work is the easiest to remove when you have to cut your staff costs. So this suggests, doesn't it, that employers are being a bit tentative in terms of taking on new full-time people, and they prefer to take on part-time people because it gives them more flexibility, possibly.
Yeah. So some of the strength we've seen in the UK labour market is caused by a rise in part-time work rather than full-time work, which suggests the labour market may be weaker than the headline numbers suggest.
Yeah. This is the HMRC payrolls month on month. I mean, it's showing an increase in payrolls every month this year so far, but not as large as the increases last year on average. Well, this chart is a chart of the SpaceX rocket just after actually it had that incident. It looks a bit like the CPI chart for the UK, doesn't it, Keith?
Yeah. Well, let's hope the trajectory is a bit like the SpaceX rocket.
Yes. Sadly, Keith, I think we're going to be disappointed on that one. So this is dreadful, basically.
Yeah. I'm really mystified by why food prices, and this is not just a UK phenomenon, this is European wide, why food prices are continuing to rise at such a pace when we know that the UN have been reporting falls in the food index for a year now.
So a few weeks ago, I read an interesting article, Keith, which basically was written by a supermarket procurer or someone who is very familiar with supermarket procurement, and they entered long-term contracts. So things like tomatoes from Spain, they're in a long-term contract that are coming up for renegotiation. And of course, the renegotiated price includes the losses that were incurred in the previous long-term contract, plus making it profitable for the long-term contract going forward. So there's a huge hit being taken. We were protected by long-term contracts, and now as they fall away and are renegotiated, we're paying the price.
Right. Okay. Thank you, Richard.
So UK CPI month on month, so 8% month on month equates to, I don't know, 10, 12.
Yeah, 9.6 annual.
That's not compounded either, is it, Keith? If you compound it, you will get
yeah, you're right.
More than that.
Yeah, frightening.
I think sort of people don't quite understand the devastation that inflation can cause when it's at these rates and or higher for a protracted period of time.
Yeah.
So there we have, we were just discussing that UK food price inflation. I'm sure a lot of it is due to long-term contracts. UK core CPI is basically stuck at 6%.
Yep.
And UK core CPI month on month is at similar 10 to 12, 10 if you don't, and 12 if you do compound it.
Yeah.
And the UK RPI, which is, so when I started off in the finance as an accountant in finance, we had interest rates around about 15%. And under those circumstances, with this inflationary environment, real rates would be zero, because we used RPI in those days.
Yeah.
Decades ago. UK consumer confidence is very low, but actually has jumped up in the last month or so. UK retail sales have actually fallen, which is contradictory in a sense. And the retail sales year on year pretty much flat. No growth there. That's EU CPI, which is actually falling quite sharply. And month on month CPI, which is actually quite high.
Yes, I know.
And there's the core CPI, which is showing no signs really. Well, a slight sign of potentially slowing down, but if it follows that trajectory, it's going to sort of level off at 8 or something like that, I would guess.
Looks awful.
Yeah, EU construction output year on year has grown strongly.
I was surprised at this, showing resilience.
Interesting breakdown of it, not that we have it, but
no, I had a long conversation yesterday with our US viewer, who's a fund manager, and he was saying that one of the reasons that construction activity is so strong is that during the pandemic, a lot of fiscal largesse went to the local states, and they have been doing a lot of infrastructure spending, which is ongoing. I wonder whether that is the same in Europe.
Yes. It could be, couldn't it? Could well be. It's so it's not private sector basically.
Yeah.
And therefore, it is not wealth creating in the same way. So EU supercore and trimmed mean inflation both saw tentative falls. They did indeed. Make of that what you will. And the EU is EDW economic sentiment indicator. Is actually very volatile, isn't it?
It is, yeah.
So it's hard to know really what it means because it is so volatile. US retail sales month on month falling significantly. And leading economic indicators in the US are continuing to drop hard. And every sort of pundit I listen to says the US is heading into recession. US retail sales year on year just dipping down a little bit. Industrial production looks quite healthy month on month.
Yep.
5-6% per annum. US industrial production year on year is not looking the same at all.
Yeah.
Slightly puzzling.
Well, it depends on, what's fallen out at the, other end.
The US budget deficit, 378 billion, which if you look at pre-COVID levels, it was around about 200. And now it's almost double that as a sort of standard almost.
I'm very surprised at this. I'm very surprised the Biden administration has not attempted to cut back on its expenditure, given that the debt ceiling has been reached.
Yeah.
They are really heading into conflict with the Republicans.
They are playing with fire with the American economy and its credibility.
Yeah.
So US Michigan consumer sentiment is what is the sort of the neutral level here, Keith? Do you know?
I think it's meant to be 100. It is a bit like, in Europe, where 100 is neutral and it's never, ever reached 100. The European consumers are universally pessimistic. And I think the default, even in the US, is pessimism.
Yeah. But nevertheless, it's it's much less volatile than that chart we saw a couple of slides ago. And it's as low as it was around about the time of the Great Financial Crisis. 1 year inflation expectations are now turning back up quite sharply.
Yeah. The Fed will not be concerned by that.
Yeah. The current conditions are improving a little bit, but are still pretty weak. Again, go back to the Great Financial Crisis. 5-year inflation expectations have really settled at around about 2.5 to 3%. US Empire State Manufacturing Index is above 0, so that's showing expansion.
Yeah, that was really surprising. But then
this one isn't.
Yeah. So each of the different Federal Reserves in the US has their own manufacturing index based on conditions in their state. And what you're seeing is just big divergence.
Yeah. And the US Philadelphia Fed Business Conditions Index has stopped plunging, but is low again. Go back to the Great Financial Crisis.
Yep.
And the Philadelphia Employment Index has been dropping quite sharply. This looks like the noise in the drop at the moment. And the Philadelphia Prices Paid Index is dropping sharply and continuing to do so. The New Orders Index is looking a bit unhealthy, but then that's in line with the Manufacturing Index.
Yeah. And that is consistent that new orders have been poor for quite a long time now.
Yes. So red book retail sales going back over the past year is showing a continuing decline. It's just positive still. Housing starts are, I think you could probably say, continuing to fall, aren't they? I think that looks like the next step will be a bit more down. But
still at very good levels, honestly.
Yeah.
Amazing.
Housing starts month on month. I think we commented, didn't we, on this huge 7.3 a while ago, but now they've just slowed down a little bit. And the NAHB Housing Market Index, which plunged, has ticked up a bit. Whether it continues to drop, we don't know yet. 30-year mortgage rate has stabilized at around about 6.5% for the time being. And the MBA Mortgage Market Index has dropped all the way down from 1,000 to 200, where it appears to be quite steady. US initial jobless claims are looking to show a higher tendency, I would say.
Yeah.
And continuing jobless claims also showing a continuing higher tendency. China growth rate, 5%. Pretty impressive.
Yep.
Quarter on quarter, 2.2%. Very impressive. And I know I'm sometimes pretty cynical about Chinese figures. but I don't feel particularly cynical about these.
Yeah. They don't need, if they're good, they don't need to be manipulative.
Yeah, exactly. Chinese retail sales year on year booming.
Yeah.
And China industrial production is pretty healthy there. Fixed asset investment is quite low and not really changing.
Yeah. Heavily manipulated, I would have thought.
Yes. So what have we got in summary? Well, we have a similar inflation picture in the UK, US, and EU, with it falling slowly, persistent core inflation, and slowly weakening labour markets. The leading economic indicators are continuing to deteriorate. The Chinese economy does appear to be firing on all cylinders, actually. And so the retail sales beat expectation, industrial production didn't. And the question posing here, are they rebalancing towards consumption-based growth as opposed to export-based growth?
Yeah, and investment-led growth.
So what's the bottom line? Well, we've got persistent inflation, meaning that the Fed and Bank of England and are all likely to raise interest rates. May meetings, I suspect the EU, the ECB will do the same at their next meeting. So we've got all the elements in place for a policy mistake. Inflation is a lagging indicator. The economy slows while the central banks tighten into it. And then the tighter monetary policy makes the recession worse than it need to have been.
Any thoughts?
Yeah, so the thought that niggles me constantly is that everybody in the world is expecting interest rates to drop quickly soon. And the thought that niggles me is, what if they don't? That's really I understand completely the logic for it, but I just say, well, what if something happens? Because we are in uncharted territory here, really.
All the central banks are forecasting that interest rates will keep rising a bit and then stay there for a protracted length of time. And the market is expecting that those higher interest rates will cause a sharp recession, which will lead to falling interest rates.
Yeah.
Now, basically, the longer inflation is persistent, the longer interest rates stay higher and the more effect they have on the economy. So,
yeah. I completely, it's imponderable, but it's a niggle that I have, Keith.
Yeah. Okay, thank you, Richard. On to one chart. Now, I thought this was absolutely amazing chart. So this is cell phone activity in downtown areas, various North American cities, change since 2019, so pre-pandemic to now. And you'll see, if you use cell phone activity as a proxy for just people moving around and occupying the center of cities, you'll see that everywhere you've seen falls of at least a third. In San Francisco, you have 2/3, less people moving around the central area. Now, this is just incredibly bad for any businesses that rely on footfall in the center of cities. And also, when we talk about real estate problems later in the year as office buildings which were built when pre-pandemic people were actually going to the office now need to be refinanced, you can see there are problems coming down the pipe.
Indeed. I think the commercial city centre commercial real estate sector is going to hit really serious problems over the course of the next couple of years. Yeah. But it's a slow one because, of course, as you allude to, Keith, they mostly have fixed rate loans, and it's only when those fixes come for renewal after 3 or 5 years, typically, that the downturn in turnover will really hit them.
Yeah, but this means that city centre restaurants and things like that, they're all going to suffer.
Yeah,
there's a big societal change actually is implied.
So now I'm going to talk about the US debt ceiling. So this is how when the US Treasury's current resources are likely to exhaust. So we've had weak tax receipts. So it's called a drop dead date, which is a date when basically the Treasury runs out of money, isn't it, Keith?
Mm.
And because tax receipts have been weak, and this has been sort of mooted for a little while now, it's likely that this drop dead rate is going to be pulled forward away from where it was originally expected to be, which was around about September, to possibly as early as June. And as we say here, that's only 6 weeks. And 6 weeks isn't very long for the US governmental system to renegotiate the debt ceiling, given all the party politics. You can see that the cash balance actually erodes pretty quickly from the beginning of the year to where we're now thinking the drop dead date may be. Well, this is a chart that shows the bond market is taking the threat of not servicing their debt and not being able to redeem debt very seriously. Historically, the Treasury has always prioritized bond payments over other expenditure. And they may come up with some extraordinary workaround, because they do. But nevertheless, this is looking pretty serious for the US government. X date, the run out of money date. When is it? Well, there's a broadening spread of potential dates depending upon what assumptions you make. But sometime between mid-June, i.e. where we hit the x-axis, and mid-November. Mid-June would be a real problem. And so stocks exposed to US government spending have substantially underperformed because investors are nervous that suddenly contracts won't be funded. And we've got some late news. So on Wednesday, Republican House Speaker Kevin McCarthy unveiled a plan to raise the debt ceiling by $1.5 trillion, which isn't very much, is it, in the context of the size of the debt? It's like 5%. In return for federal spending cuts equal to 3 times that. So total domestic military spending to 2022 levels and cap growth at 1% annually in coming years. Retirement and health programs are projected to expand dramatically as the population ages, would be unaffected, and recent green energy incentives would be scrapped, as would the $400 billion student loan forgiveness scheme. So Democrats clearly are going to reject those proposals. The Republicans are saying they serve as a basis of negotiation between the two parties, and there's an awful lot to. There's a long way between the two sides on this. So the US has effectively reached its debt ceiling, currently relying on extraordinary measures to enable it to keep paying its bills. The Republicans don't want to give anything over this, and they're saying that the Biden presidency is not engaging, and Goldman Sachs have revised their forecasts on the basis of this intransigence on both sides and the drop in tax receipts, giving the drop dead date sometime in June. So
yeah. Well, the thing is, during the pandemic, when we had the last debt ceiling negotiation, both sides just wanted to spend vast amounts of money. So there really was no negotiations. So the last time you had real problems with the debt ceiling negotiations was under the Obama administration. And now the US polity seems at least as divided as then. And when you look at the trajectory of US debt, is just on a totally unsustainable path. And something does need to be done about it. Now, the Biden administration does not seem to be engaging, and I think the Republicans are serious. So this could actually get very nasty.
It could. And we have, if it is the middle of June, there is, as you say, there's only 6 weeks, 7 weeks to get it fixed. And given that they're very far apart, that's not a long time for people to change their positions. So, I mean, the other point, of course, is that if Biden does what the Republicans do, it would seriously damage his chances of being re-elected at the next election.
Yeah. And one thing that we have covered in recent weeks is that how the US government has been adding jobs in quite substantial numbers. And, you'd be thinking that with the debt negotiations coming up, you'd trying to conserve money. The Biden administration is not being prudent, I would say.
I would say that I completely agree with you, Keith. There's vast sums of money that they've allocated to various programs, which the US actually can't afford.
Yeah. Okay, now we've changed around the order this week because I wanted to cover this. Now, the credit impulse. Now, the credit impulse, I think, is quite an important concept, and it's very badly explained on the internet and in lots of different places. It's taken me quite a while to work out exactly what it is, and I think it's important, and I think you should know about it. So, GDP is a flow measure. It measures the flow of goods and services through the economy. And so because GDP is a flow measure, a constant level of GDP requires a constant flow of credit. Okay. Now, if you want to change the level of GDP, you also have to change the flow of credit. So the credit impulse is the change in new credit divided by GDP. So it's the change in the flow of credit, or it's the second derivative of credit. It measures whether credit creation is accelerating or decelerating. The central idea is GDP is a change in economic activity, and a given level of GDP needs a given level of credit. Therefore, changes in GDP require a change in credit flows. And this was an idea first coined by Michael Biggs of Deutsche Bank in 2008. And for those of you with a mathematical bent, this is the formula. And actually, this may be the clearest expression. Pause, take a look. Now, the easiest way of getting your head around this is a worked example. So let's imagine an economy that is entirely private spending. So spending, therefore GDP, is column 3. Now this economy already has debts of 200. In year 0, the economy spends its income. GDP is 100. In year 2, it pays back £10 of borrowing. Its spending is 90. So GDP has fallen by 10%. And the credit impulse is minus 11%. In year 2, it continues to pay down debts, but at half that rate, minus 5. So spending actually rises from 90 to 95. So GDP has increased despite the fact that credit continues to fall. So the change in credit continues to be negative, but GDP has risen. Credit impulse is positive. So because the rate of change at which you're repaying debt has fallen, the credit impulse is positive and GDP has risen. Richard, is that clear?
Yes, it is. It is clear, isn't it? I mean, a simple way of looking at it is to say that if you have debt and you are repaying your debt, then that cash is not available for GDP activities.
Yes.
If the rate of repayment of the debt reduces, but your income remains the same, you have more cash available for GDP activities. But of course, as debt gets repaid, the total amount of credit in the system is reduced.
Yeah, but I think the really important thing is that it's the rate of change of credit, not changing credit itself.
Yeah, exactly.
So history shows there is, as you would expect and predict, a strong correlation between changes in the credit impulse and private sector demand, as shown here. And credit growth is poorly correlated with GDP growth. Credit impulse is well correlated. So that is in line with theory. Now, how do you measure the credit impulse? Well, actually, for most economies where the banking sector provides most of the credit, then using bank loans is a good proxy. Now, if there's a big shadow banking sector, that may be an imprecise assumption. but it's the best data we have. And in doing the original work, Michael Biggs said that the 6-month change in credit impulse is the best definition because new loans are not fully spent immediately, but they tend to be fully spent within a year. So 6-month average was best. Now, actually, I couldn't find 6-month data. So I used data from the St. Louis Fed and I made my own. And you'll see here that the yellow line is 6-month change in credit as percentage of GDP, and the white line is the credit impulse. And you see the credit impulse is already strongly negative in the US. And why this matters is because I've been seeing for the last few months forecasts that the credit impulse is going to be very negative, and hence we have a recession in the second half. Even as credit as percentage of GDP remains constant in the second half of this year, credit impulse will be strongly negative and we'll have a recession. And this is all from Robin Brooks of the International Institute of Finance. So the red line is credit growth. The blue line is the credit impulse. You see that turns very strongly negative. And we've known for a while now that lending conditions have been tightening everywhere. So we'll have a negative credit impulse in both the US and the Eurozone for the rest of the year. In the Eurozone, we're very heavily dependent on bank lending, and even worse in the UK. So bank lending is very much a decent proxy for the credit impulse. So in summary, credit impulse is the second derivative of credit. And we know that the failure of Silicon Valley Bank has resulted in a drop in loan provisions from small US banks, which seems unlikely to fully reverse. Therefore, a drop in the credit impulse is inevitable, and a recession is likely in the second half. And because of the debt ceiling negotiations, it's unlikely that the drop in private demand will be offset by a rise in public sector demand. And the reason I covered the credit impulse is to go through Financial Crisis Watch and see how the banking system in the US is doing after the failure of Silicon Valley Bank. Now, we know that we saw big outflows of deposits from the banking system in the aftermath of the failure of Silicon Valley Bank. Now, last week, that reversed. For small banks, actually, we've had 2 weeks in which deposits have been growing. And deposits also flowing back into large US banks, despite continued inflows into money market funds. So all that paints a picture of depositors regaining their confidence in the US banking system, and which potentially would be good for loan growth. But actually, that is probably not what's happening. This week is the week when US citizens start having to pay their taxes. And in order to pay their taxes, they need money in their bank accounts, not money in a money market fund. So if you look at the seasonality of US deposits, what you see is big inflows in April, which is where we are now, and then enormous outflows over the next couple of weeks. So the thin blue line is deposit flows this year, and they've been incredibly weak. And now, if the changes in the current year are similar to in an average year, you'll expect to see very strong deposit outflows over the next couple of weeks, including this week. But in aggregate, loan growth is rising again. Loans from small banks have actually stopped falling. Loans from large banks look perfectly normal. Bear in mind that there will normally be a lag between tightening financial conditions and loan growth, because loans need to be approved weeks before the money is actually given. Real estate loans, this is monthly data, seem to have stalled. Commercial and industrial loans, this is monthly data, and this data for February seems to already be falling. And thinking about the credit impulse, that will be negative. Good news is that the banks in the US seem to be making less use of the Fed's emergency lending measures, liquidity measures. But as a result of that, the Fed's balance sheet is falling once again. Reminder, it's still doing QT, and therefore the liquidity impulse is falling. And we've talked many times before about this correlation between equity markets and financial liquidity. Well, liquidity is falling. You might expect that the S&P 500 will now have a bad period. And this chart shows that bank lending tends to follow lending standards with a 12-month lag, which I'm surprised the lag's that big. But anyway, we've had tightening lending standards for a while now. And if that historic correlation continues, then you should see bank lending fall. And small businesses are reporting that loans are more difficult to find, unsurprisingly. We know this week, JP Morgan and some other large US banks reported good results and their share prices rose. But small US banks, their share prices aren't recovering. There's still problems in small US banks. Now, the market seems to think that this crisis has gone away, and the Goldman Sachs Financial Conditions Index actually has been falling after the last few weeks, having risen when Silicon Valley Bank failed. But reminder, this uses market measures such as option spreads and is more a measure of financial risk appetite than lending conditions. Now, I thought this was interesting. Leveraged loan issuance this year has been a disaster. Lenders are very wary of companies with a poor credit history and existing debts. I think things are playing out as I sort of predicted after Silicon Valley Bank failure, where market sentiment has recovered, but financial conditions underlying are continuing to deteriorate. And I think later in the year, we will get recurrence of banking problems. So bottom line is that small US banks have suffered a large drop in deposits seems unlikely to reverse, and the recent small inflows are very likely to turn to massive outflows in the next couple of weeks as US citizens pay their taxes. So credit conditions will tighten, and we know that a lot of commercial real estate loans will need to be refinanced later in the year, leading to further bank losses. So everything is in place for a credit crunch. Okay, Richard, on to Inflation Watch.
Good news, Keith. And I think what you just said is very important. I think to summarize, we're not out of the woods. SVB seems to have been stabilized, but there's an awful lot of going on under the surface, which may well come up and cause problems over the next few months. Yeah,
good summary.
I like summaries. It's just a sort of quick note to self, isn't it? Inflation Watch. So Keith went through the inflation figures at the start, and we know that effectively the UK is very poor. The US and EU are sort of similar levels. Inflation is proving to be much more sticky than the central banks ever thought. In fact, the word transitory should be expunged from their dictionary.
Yes.
And Japan's inflation is still a bit high in comparison to where it has been, but it's actually remarkably low.
Yeah, it's actually come down. So in January, it's 4.2%. It's dropped quite sharply.
Yeah. So plenty of UK companies complaining about the shortage of labour shows that a tight labour market is fueling wage inflation. So the CBI surveys show that the skilled workers are very much in short supply, and even unskilled workers are relatively short supply. And clearly that drives the bargaining power of the workforce.
Yeah, but It is falling, but from very high levels.
Yes. So this is the available workers to fill the available jobs, and basically we are at a point of 1-to-1, which means that the labour market has no flexibility, very little flexibility in it. I mean, the interesting about that is the trend, isn't it? It's been on this. What would reversion to the mean look like? Is my question, I suppose.
Yeah.
A gap of, looking at this screen, maybe 1 unit.
Yeah. It's surprising, this actually, that the jobs growth has been so strong, because that would imply a stronger economy than we've actually had, I would have thought.
Yes, I agree, Keith. So as a result, UK wage inflation is higher than elsewhere because there's more bargaining power in the labour force. That, of course, is bad news for the stickiness of inflation. And this is chart CPI energy inflation, which is falling everywhere, but more slowly in the UK than anywhere else.
Yeah.
Because of our heavy reliance on natural gas.
Yep. But it should come down quite sharply now, but still, that's, consumers have suffered a big hit from very high energy prices and very high food inflation.
Yeah. So we have a continuation of falls in steep falls in UK inflation. I have to say they've adjusted their protractors, haven't they? This is not 90 degrees. This is about 140 degrees.
I knew you'd like this, Richard. It's like they haven't changed the terminal date.
No, they've just steepened the chart to get there.
Yeah, exactly. So the fact that inflation has proved very high for the last few months and made no change whatsoever.
Yeah, I just don't believe it. US sticky and trim mean inflation are both coming down. So yeah,
that's good news in the US, not in the UK though.
Yeah, and the Atlanta wage growth tracker is showing much more persistent wage inflation than the BLS, and we've just discussed in the past that the BLS is a survey and people don't respond to it.
Yeah.
So the Atlanta median wage tracker is suggesting that wage inflation is stuck at around about 6 to 7%.
Yes, the Fed needs to keep raising, basically.
And we saw that the less well-paid reaped the initial benefits, but the better paid are now catching up.
Yeah, actually, the trend, the blue line, is not good.
Well, it's not, is it? And advertised wage inflation is falling, as are hiring plans. So this is obviously the inflation of job adverts, inflation of rates of pay in job adverts. And so in the US, rising immigration ought to help ease the labour shortage.
Yeah, I thought this was really interesting, actually. So unlike in Britain, where part of the reason for the tightness in the labour market is Brexit and the lack of workers from the EU. In the US, actually, the foreign-born immigration is almost back to trend. So, you can see there that the labour market conditions are easing.
So warn notices, these are the notices that larger companies have to give if they're intending to lay off staff. So wage inflation have risen sharply. It suggests that wage inflation should drop in the coming months because basically the labour market will get looser. And there you can see the black line of initial jobless claims gently starting to trend up, and the warn notices having moved ahead sharply. And US trueflation, which is another measure of inflation, a private measure of inflation, has stopped falling at 4%. And UK trueflation, those are results, Keith.
Yeah, only 16.2, Richard.
Oh no, you're looking at this entirely the wrong way. It's fallen by 6%.
It's world beating is what you should be looking at, Richard.
Yes.
Yeah.
Yes.
One thing we still do well, inflation.
Yes, Keith. I had to say, Rishi Sunak's pledge to halve inflation in 1 year is looking a bit dodgy, isn't it?
No, he will achieve that. He'll get to. It will get to 8.1.
Corporate revenue growth continues to beat the Fed's 2% inflation target, which means, presumably, well, you've got economic growth, haven't you? So it's a combination of economic growth and inflation.
Yeah. So, but the bottom line is that if you look at another measure of, prices in the economy, i.e. revenues, then they're way higher than the Fed's 2% target.
And we're now starting to see annual declines in rent since the start of the pandemic. And rent, of course, makes up a big segment of the services section of the US inflation measure. So inflation is falling much more slowly than anticipated, although projected to fall faster than previously. And core inflation remains persistent because of tight labour markets. There was nothing in this week's inflation data to dissuade central banks from further increasing interest rates.
Okay, thank you, Richard. On to recession watch. And well, the good news is that jobless claims, sorry, I should say, I thought I was on inflation. Let's start again. So jobless claims in the US have been rising. The labour market is tight, and that is bad for the economy, but good for inflation. Now, the ISM new orders minus inventories continues to look very poor. And so when inventories are high, then new orders should fall because retailers have got enough stuff. Now, house prices are falling, and you'd expect that to continue as home price affordability in the US continues to be very poor, although we are mystified by the continued strength in construction in the US. The New York Fed's recession indicator has never given a false signal and is once again very strongly signaling a recession. But recent data from credit card networks and banks in the US portray the US consumers doing very well, thank you very much. So this is from Bank of America, and you see volume growth on their cards network rose by 9%, transactions rose by 6%. They also stated they hadn't seen any deterioration at the end of the quarter. I also read the American Express results, and they were also saying that consumers seemed resilient, which seems in contradiction to the retail sales figures we showed you earlier, which showed retail sales falling last month. In summary, leading indicators continue to forecast a coming recession. The actual data continues to be much more resilient.
So looking at some other charts, long-term loans to Chinese households rose sharply in March, suggesting they are interested again in purchasing property.
Yeah, I'm really surprised at this, given the state of the Chinese housing market. We know, the average house price to income in China is just totally ludicrous, off scale. Yeah,
maybe the Chinese government has succeeded in persuading people that it's still a good investment.
Well, as long as there's nothing else they can invest in, perhaps that works.
Yeah. House prices everywhere are falling as interest rates rise, obviously what one would expect. And they are falling particularly fast, actually, in Sweden and New Zealand and Australia.
Yeah.
I mean, the Australians had an enormous housing boom, didn't they?
Yes, absolutely. Well, I intend to do some. I've been asked to do something on global property prices, and I intend to do that in the coming weeks. But behind the scenes, we have actually got a load of stuff that we haven't had time to cover. So there's a big backlog of stuff to cover in the coming weeks. Okay, on to good news. And I like this. So on the left was the state of this river in India, and it became biologically dead. It was a tributary of a river somewhere. And now it has been totally revived. So what they did was they got the local villagers to come in, dig out all the rubbish, clear the dead and dying undergrowth, and then they cut back the banks, widened the river. 5 years later, you'll see the river is much wider and is back to full health. So, it can be done if put a mind to it.
We need to show that to the UK water companies.
Well, I'm actually very encouraged that Fergal Sharkey is now the chairman of Ofwat.
Is he?
Yeah.
Well, someone needs to wring their necks. That's not Ofwat.
Exactly.
I mean, well, maybe Ofwat as well, but
Yeah, no, something might be done.
Yeah, it's just a disgrace.
Yeah.
So thank you, Keith, for that piece of good news. Moving on to the weekly checklist and equity markets. There wasn't very much going on in equity markets on average over the week, I would have said. The Hang Seng was down 1.9%, which is quite a largish movement, and Bitcoin was down 9%, but it had a year-to-date change of nearly 80%. So relatively quiet week in the markets. The pound only down 1.3% against the dollar. And I find this surprising, actually, because we've got this dreadful inflation, and it's much worse than anyone else's. And it surprises me that the pound is so resilient. And then the euro also down 1.1% against the dollar, and consequently, effectively, the dollar index up 1.2%. And the dollar is actually in the midst of a significant downtrend, and I think 100 is considered to be a point of resistance for the dollar index. So we will see if it falls through that, particularly with the debt ceiling issues they've got. And the VIX is continuing to show falling volatility, which means that the stock markets are effectively going up.
Yeah, I have been following the suggested strategy of selling below 20. I sold when it went below 20, just continued to fall, and I'm losing money on that particular little punt. But at some stage, I expect the contradictions inherent in the equity market to reveal themselves.
I think you're right, Keith. I think it's just a question of time, and not to get taken in by them in the interim.
Yeah.
Recent equity market gains have been caused by increases in valuation, not earnings, i.e. the multiples have gone up, possibly in anticipation of falling interest rates. And stock market breadth is the weakest on record, which means that a few companies, mostly the FANGs in the NASDAQ, for example, are responsible for the vast bulk of the upward movement, which means that everything is not as it seems on the surface. So Morgan Stanley pointed out that European EBIT margin forecasts remain very high. That's quite an interesting graph, this, isn't it? If you look at the sort of 20-year average, it's around about 12, I would guess, and we've got 14 and a half here. So you're looking at a 20% over forecast, if you like, potentially. Morgan Stanley are also forecasting a big decline in margins over the coming year.
Yeah.
Too high. And obviously that will affect valuations. Even if multiples stay the same, valuations will drop. If interest rates go up, multiples will drop as well. It means the stock market's not a very safe place to be. So earnings forecasts for 2023 are continuing to decline. So basically, analysts are very enthusiastic at the start of the year, and then they slowly have to reduce their estimates to enable companies to beat them, and so that they don't look completely daft. And what you see here is in 2023, analyst estimates are actually falling very fast, much faster than normal. And the Bank of America is forecasting further declines in global corporate earnings in 2023. The earnings part of the price is going to fall, which is what you'd expect if we're going into a recession. And the current forecast, on average, is 6.7 decline in earnings per share. So,
Q1. That should say in Q1.
Yeah. Hedge fund positioning. Hedge funds really aren't in the S&P. Well, not in the S&P, but their positioning is very light in the S&P, which means they don't believe it, and they don't always get it right. But that's their point of view. It also means that someone else is propping up the percent of the yield curve inverted at the moment is about 85%, and this level of yield curve inversion is always portended of very poor stock market returns because of the impending recession. And be careful. Yeah,
but you notice that these inversions peak sometime before the recession actually starts, and I think that's where we are.
Yeah.
Okay, thank you, Richard. On to commodities and energy commodities, and it was generally a very poor week. So despite OPEC Plus cutting 1 million barrels, or saying they're going to do, they failed to keep the oil price up, and fears of a coming recession leading to falling oil prices. So Brent was down 6.7% of the week, as was WTI. Natural gas in Europe continues to drift off. Hurrah. US natural gas futures had a strong bounce from extremely low levels, still down 50% on the year. Coal stabilized, again down 50% on the year. Uranium continues to climb as is the only energy commodity that is up on the year. Numbers specific to the oil market, well, we had a small draw. So including the SPR, the inventories in the US fell by 2 million barrels, excluding the SPR by 424. So the US is continuing to use stocks from the SPR to make sure that the US oil market is well supplied. Obviously, they can't do that forever. And a draw in the US inventory should have been positive for oil prices. It wasn't. US crude production was stable at 12.3 million barrels, and the Baker rig count continued to fall, down 2. This is crude. So you see jump when OPEC Plus announced their cuts, and now it's fading again. The market is not convinced that the OPEC can keep the oil market tight. Now, good news for the oil market is that global flights have reached a new high for this time of year. People still want to travel. Now, China's oil imports rose by 1 million barrels a day in February, but that is seasonally quite normal. EU natural gas futures, this is the 10-year view, falling, but the rate at which they're falling seems to be slowing and still a long way above pre-pandemic and pre-war in Ukraine levels. The same is true for the UK. So the white line here shows that EU natural gas stocks are at a record for this time of year after a mild winter. And so given the fact that storage in Europe is not expanding that much, then you shouldn't see actually that much demand for LNG cargoes this year. And part of that low consumption was caused by a mild winter. But also we know that European businesses and consumers have cut their consumption of natural gas by about 18%. US natural gas, long-term view, right back towards their decade lows. Over the coming 7 years, so we are now in 2023, and this is LNG export capacity forecasts for the US to 2030. And you'll see it's forecast to more than double. And so the US is building a lot of LNG capacity, and that should get rid of some of the glut. Now, this is the energy mix for power generation in the US over the last 20 years. And the US has cut its global gas emissions, but mainly by switching from coal to natural gas. There's still 19% coal in the mix. And so with natural gas prices very low, you would expect that switch to continue. See that wind has grown from nothing to 8%. Solar, 1 or 2%. We're still very much dependent on hydrocarbons and nuclear. This is coal, stop falling. Uranium, pretty stable. Richard, industrial commodities.
Thank you, Keith. So the quite a lot of variety this week for industrial commodities. Aluminium up 1.5%, unchanged effectively on the year. Cobalt unchanged on the week, but down 33% for the year. Copper, a big change, down 4.3%, possibly in anticipation of US recession. But year to date, up 4.5%. Chromium, little change this week and 3.5% down for the year. Iron ore actually pretty much unchanged both on the week and very small increase for the year. Lithium continuing, just Chinese lithium pricing, which is different from non-Chinese lithium pricing, but that's continuing to fall really hard, actually, and down 66% for the year. Mind you, it had an enormous rise last year. And neodymium, interestingly, down 5.5% and down 36% for the year, which suggests that was a bubble at the end of last year, doesn't it?
Yeah.
Nickel up 5.8%, having been down over 20% for the year. And tin up 12.7% for the week, which is, I don't know what caused that at all.
No, but it's been falling very sharply, and it's a dead cat bounce possibly.
Yeah, ferrovanadium down 1.6 for the week and 1.4 for the year, so not very much change there. And zinc down 3%. So a big variety of moves there. So we have aluminium and cobalt, copper. All the forecasts are that copper is going to go into supply shortage. CTA's exposure to copper is pretty high. Chromium, iron ore, lithium, which is retraced all the way back to January 2019. Well. Neodymium, which has just lost all of the bubble that it was in. A bit like gas, isn't it? Nickel has got a just steady uptrend, actually, if you ignore the spikes. Just put a line between mid-2020 and now. It's on a steady uptrend. Tin, ferrovanadium, zinc. So looking at precious metals, gold and silver about down 2.7%, 3.5% for the week. They've both had reasonable starts to the year. Gold up 9% for the year, silver up 4.5% for the year. The industrial precious metals, platinum, rhodium, and palladium, behaving differently, up 3.5%, 5.3%, 5.2% respectively during the week, but big differences on their year-to-date behavior. And presumably the platinum, rhodium, palladium have increased because of some industrial factor that I'm not aware of. Keith, are you aware of anything?
Well, I think they've just been beaten down so much they were due a bounce, basically.
Yeah, quite possibly. So there's gold, silver.
I mean, both of these we'll see in a second, but rates had a bad week because of the inflation numbers. Yeah. And I think it's just reciprocal of that.
Yeah. Platinum, rhodium.
Not much of a bounce, quite honestly.
No, tiny, isn't it?
Yeah. In percentage terms, it might be, but when you look at the trend, it looks awful.
Yeah, and where it's come from.
Yeah.
Palladium.
Okay, thank you, Richard. On to rates, and it was a very bad week. So, we had inflation numbers in the UK and Europe, and following on from bad inflation numbers in the US last week. And all that led to a revision in the market's expectations for the path of interest rates, and interest rates to be higher for longer. So the whole of the UK yield curve shifted up. And we had a similar shift up in the yield curve in the Eurozone, but to a much lesser extent. The market is concerned about the persistency of UK inflation, as they should be. So this is the UK 2-year. You see, a couple of weeks ago, after the crisis in the US banking system, so interest rate expectations were falling. Well, they've risen again. A 10-year back up to pretty much its highs for the year, as is the 30-year. US 10-year also had a bad couple of weeks. German Bund yields was bad couple of weeks. Italy. Greek 10-year. Any change to your views, Richard?
No, Keith. No change to my views.
Okay, concluding comments. Well, I'm afraid inflation has proved to be much more persistent than anticipated. Core inflation is just not coming down at the moment anywhere. In the EU, it actually rose month on month. And the month on month figures in the UK we reported this week were really awful. Despite that, labour markets are weakening, and the expectations are that inflation will come down sharply later in the year. But we've been saying that for a while now. The credit impulse will inevitably be strongly negative later in the year, and that implies a recession. Richard, how did you get on this week?
Thank you, Keith. So, although my change for the year is remaining reasonably a reasonable level, the FTSE all shares caught up substantially. So my relative performance is only 4.1%. My, as a reminder, my portfolio basically consists of precious metals and commodities, and I haven't made any changes. This is the gold price in pounds, and it's actually not quite an all-time high, it just fell down here, but you can see that if you take the price since let's say 2016, it's gone from about 700 to 1600. So in 5 years, very roughly, it's gone up by over 100% in pounds. Obviously, this is an indicator of the weakness of the pound, because the move in the dollar has been much less than that. Yeah. The other interesting thing here is that the price of gold, this is a monthly chart, long-term, quite a long-term chart. The price of gold keeps hitting this level at about 2080. And if you were a chartist, you would say that if it broke through this line, then the uptrend would continue. Now, I'm not a chartist, but I'm hoping that does indeed happen.
Right. Well, fantastic performance, Richard. Well done.
Thank you, Keith. But these things, they turn on a dime, don't they? Because they, we live in a very volatile world. How about you, Keith? How's your week been?
Unlike you, Richard, I'm afraid my performance has been absolutely shit. So I had a terrible week, as my long bond trade did very badly when interest rates ticked up. And, that means in the last 2 weeks, I've basically lost 6%, which is terrible. Yeah. So in summary, I play the cycle. I have been anticipating for a very long time now, it feels, that the markets would, that the economy would turn down and that'd take inflation down. But actually, the economy's been astonishingly resilient to this very rapid rise in interest rates, much more resilient than I anticipated. And that means I've been wrong and I lost money. But, in essence, I have underestimated the length of the lags. But I still expect that those rapid rises in interest rates to have an effect. And, the longer inflation persists, the more central banks will raise interest rates. As we talked about earlier, the greater the chance of a policy mistake, i.e. they over-tighten, which will bring the economy down further than it otherwise would. So not great. I'm not feeling great about the portfolio or life, but, I've had a good few years, and I fully expect to make it all back plus more later in the year. So, not much fun.
You're sticking with your thesis, Keith, which is very, very fair. I'm reminded that we put on Portfolio Matters a few weeks ago the change in interest rate that Stuart actually experienced when he went from his fixed rate, which expired, to a new fixed rate. And the amount of interest that he paid, it was astonishingly much larger. And that's happening to households, unfortunately for them. That's happening to households up and down the country every day at the moment. People are coming out of fixed rates and being faced with vastly larger mortgage payments. And that is bound to have an adverse impact on disposable income.
Yeah, absolutely. And in addition, we've got, we have this cost of living crisis. Yeah. And that means that disposable incomes have to come down, and that has to slow the economy. Now, the figures in the FT this morning were that there are 1.9 million homeowners on variable rate mortgages and 1.4 million on fixed rate mortgages, which will go onto a variable rate or need to be refinanced at much higher rates during this year. So as the year progresses, we expect those higher interest rates in the UK to have more and more effect.
Yeah, I think so. And I suspect it's going to be non-linear. We're going to have a sudden sort of explosion of mortgage payment defaults and so forth, because basically it's cumulative, isn't it? It's not linear, it's cumulative. As more and more people come off these low fixed rates, then they all experience the same effect.
Well, but also your point about the economy as being non-linear. I mean, the whole way a recession works is there's a negative feedback loop. So people start cutting back on expenditure, which means that businesses start cutting jobs, which means that expenditure drops further, et cetera, et cetera. You get into a negative feedback loop. And we haven't had that yet. But, I'm still expecting it to happen, he says.
It will happen, Keith. I'm absolutely certain you're right. It will happen.
Yeah. And so just as I've lost 6% in 2 weeks, frankly, in 2 weeks, I can get it back again, So thank you all for watching. It's nice to have Richard back. Please, can you press like and subscribe to the channel? Now, new policy. I am posting a PDF of the weekly presentation to the Discord for those of you who want to peruse it at your leisure. So if you're not a member of the Discord, you can find it there. In the meantime, it's goodbye from Richard Guita.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.